All right, all right. Here we are. Good morning, good morning, good morning. It's great to see everybody first thing in the morning. We have a new class starting today. We started a new class on Monday evening at the university, and this is our first lab for that class. And this is the first class of the first class, the first class of the first class, because we have three classes in each class. So, how do you say that? This is the first class of each section, and we have four sections. All right. So, first class of the first section of four sections. So, we're going to introduce everybody, and we're just going to get started here. Just kind of covering the things we covered in class. All right. So, it's going to be a very beginning class. And for those of you who have been here before and are part of the class and been for a while, you get to start over. All right. Because that's what this is. This is the lab for our university classes. So the first thing we're going to do is we're going to introduce you to the fundamentals of the stock market. All right. And so as we talked about in class, we talked about the Dow, we talked about the Russell, the Nasdaq, and we talked about the S&P 500. We talked about where these exchanges are located, and the three biggest exchanges are in New York City. We have the New York Stock Exchange, which is the largest stock exchange. We have the NASDAQ, which is the second largest. We have the AMX. We have the American Stock Exchange, which is the third largest. We also have exchanges all around the world. And we also have exchanges for the futures market over in Chicago. And I mentioned that that's where I spent about 10 years of my time um, hanging out at the Chicago Board of Trade. So I have a very strong heartfelt place for the Chicago Board of Trade, but we do love to trade stocks too. And they're two separate organizations, two separate structures. And to trade them properly, you really kind of need two different versions of the software. If you're going to trade the stock market, you need stock software. And here's a stocks trading platform. This is the one I use, Track and Trade. You can go get a copy of trackandtrade.com. If you're going to trade the futures market, which is what we do on Tuesdays and Thursdays in the afternoon for Power Hour, we use this version of the software, which is the futures version. Futures version connects to the futures market, which is out of Chicago, connects to those exchanges. Stocks version connects to New York and connects to those exchanges. And it's important that when you're trading, you have a good trading platform that allows you to make those trades and to analyze markets properly. All right. So those are the software programs I use, and you can get those online at trackandtrade.com. So this is Track and Trade, and this is the stocks version. So we're going to be talking about stocks this morning, and I want to take you through, and we're going to analyze. We're going to talk about the four indexes that we talked about in class. So we're going to talk about the S&P 500, which you see up here in the upper left-hand corner, and that is a daily chart. So each price bar represents one day, open, high, low, close for that day, how the market moved through price and time. And then we talked about that in class. We have slides for that. I can pull those up here really quick. And so we can see in here in the slides, we have open, high, low, close bars. This is how we have candlestick charts. And you can see that they have the upper shadow, the lower shadow. I call them tails, upper tail, lower tail, bottoming tail, topping tail, whatever you want to call them. This is the body. Okay, so this is the high for the day, low for the day. This is the open, this is close. It closed higher than it opened, which is why it's green. This one here closed lower than it opened, which is why it's red. So you can make these for any time frame you want. You can make them 1 minute time frames, and then you see what we call a 1 minute chart. And every price bar would represent the open, high, low, close for the 1 minute time frame. You can make them 10 minutes. You can make them 15 minutes. You can make them whatever time you want. It's user definable. And usually when we're trading the stock market, we like to spend most of our time looking at daily charts. So each price bar represents one day, and it's the open, high, low, close for that day. And then when we string a whole bunch of those together, right, we get a chart like this. And then you see what we call the trend. Okay, so I'm going to bring the S&P 500. Now remember, the S&P 500 is 500 stocks. The Dow, DIA, the Dow, and we use a symbol to represent each one. And you see we have up here a little place in the software we can type the symbol. And so the symbol, let's actually close this one. Let's close the Dow and we'll open it back up just to show you how. You just type in DIA right there and you hit open symbol and there's the Dow. So that brings that up on the screen. And the way you get one chart on the screen versus multiple charts on the screen is up here in the upper right-hand corner. You can see we've got a little line, which will, what we call, Windows. This is Windows. It's a Windows application. And so that minimizes it. It doesn't close it. It just makes it go gray right here. You can see in the list, it's gray. It's still open. It's just grayed out. It's not listed on the screen. So you double click it, bring it back. If you want to go full screen, you can go with this little button here in the middle, which will bring it full screen. So there's the Dow full screen. And then if you want to go back to the multi-screen, you do this. And then if you want to kill it altogether, you hit the X. And so then now it's gone. All right. To bring it back, you just type in the symbol again, DIA, and that's the symbol for the Dow. And of course, the Dow is 30 stocks, right? So the Dow 30. So you have the S&P 500, which is 500 stocks, the Dow, which is 30 stocks. You have the Russell 2000, which is 2,000 small cap stocks traded primarily on the going to be on the AMX, on the American Stock Exchange. And then you have the down here in the bottom right hand corner, we have the QQQ, which is the NASDAQ, and this is an index of the NASDAQ funds. All right. And it's got 100 NASDAQ funds on the NASDAQ exchange. And now remember, the NASDAQ is highly correlated to the tech industry. So Apple, Amazon, Netflix, a lot of those different funds are all traded on the QQQ. Okay. And they're not equally weighted. So just because there's 100 stocks in there and you buy into the QQQ and then they spread that money out for you, diversification, right, into 100 stocks, it's not equally weighted. They don't give all of them the same weight. So they got some stocks that are more highly weighted than other stocks. We talked about that in class, and we showed you which ones were highly correlated to the top versus the ones that have very little in the bottom. So they do correlate to different stocks at higher rates. And all of them do that. Okay, they all do that. They're not equally distributed like you might think they would be, but that's how they work. That's how they do it. Okay, so we can go through and we can look at this and we can decide whether we want to get in. The name of the game of trading is buy low, sell high, right? So if you're going to trade, you want to buy low, sell high. And the software kind of shows you, let's bring one full screen again. Let's bring up the Dow one more time. This is the Dow 30. The screens, this kind of shows you where to buy and sell to some degree. Now, we also use a lot of indicators. Now, when we get into the next class, we're going to move into a class called at the university, it's called day trading. It's a day trading class, but really it's a technical analysis class. It's where we're going to learn about indicators. We're going to learn about trend lines. We're going to learn about all kinds of different mathematical models that you can use to help you identify when the best time to trade is, how markets have a tendency to move through price and time through different patterns. We oftentimes look for trends, or three drive patterns is what we call them. Those are called Elliott waves. We kind of look for retracements, or what we call the delta cone of probability. And those are how the market moves back against its previous trend. There's all kinds of fun things that we can do to help us model out where the market's going to go. I have a nice little Sunday school lesson at the end of class that I'm going to give you that kind of talks a little bit about that. So we're going to talk about that. Make sure you stick around for the Sunday school lesson at the end. And we're going to just kind of go through and analyze or look at from a very, broad view of some of these markets. And we're going to talk about how we can trade these. All right. So there's a number of ways to trade them. And of course, we talked in class about a way to trade these where we would dollar cost average in. So we don't really take into consideration where the market's at any given time, whether it's high or low. We did talk about buy low, sell high, which is pretty obvious when you look at it in hindsight. You want to be buying down here in these regions here, and you can see when the market changes, it has a downtrend. And so this is called a trend. All right. So you have small trends. And so you can see the small trends up here, and we'll just draw a trend line and underneath the bottom of the chart. So when a market's going up, you're going to draw your trend line from the low up through the bottoms. So it's kind of, we call this support. All right. So that's support. And then as the market turns around and comes down the other side, give me 1 second. I got to drink some tea. All right. And so then it goes down the other side. That's called resistance. Okay. So up on top, This is called resistance. And down on the bottom, this is called support. So when the market changes directions and goes from down to up, it gives you a little color switch. Okay, so we're now no longer making lower highs and lower lows. We're now making higher highs and higher lows. And as the market goes up and rolls up over the top like that, we draw another trend line. We just kind of draw a line up underneath there. And it's kind of, you can see where the kind of market kind of rolled over the top of that. And then you get the resistance across the top. And then it switched over here. It kind of went a little early on this first one, faked us out a little bit like a good running back on a football team, right? Faked us out, said, hey, I'm going along. And then it didn't. And then it did it on the next one. So then it took off and it went again. And there you go. It's all green, 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 green. That's your support. And then when it gets up to the top of the support, it breaks that and turns red. And so that's just kind of the simplest, easiest way to know when to buy and sell on markets, just by using areas of support and resistance along these trend lines and the color code of the price bars. So it kind of tells you when markets are going to go up and down. And if you just did that right there, you'd probably be better than most traders, because most traders try to complicate it, make it harder than it really is. You just kind of trade the red to green, red to green, red to green. Now, we do have a very special tool turned on. I have to admit, we have cheat codes turned on. Now, in Track and Trade, there's a cheat code up here. It's called the Heikin Ashi. All right, so if I turn off Heikin Ashi, this is what most charts look like. So if you go out and get some other charting service, or you go out to the web and you open up a chart, this is what their charts are going to look like, and makes it a little bit more difficult to see. So in Track and Trade, we have a tool called the Heikin Ashi bars, and some of the other programs will have that too. But we like it here in Track and Trade. And if you hit that little button right there, now that little button doesn't show up when you get the software out of the box. It's a little bit different than the way I set mine up. I've tailored my software to do a lot of things differently than how it comes out of the box. So I use it. And if you want me to help you set your software up like mine, I'd be happy to do that. We can go through class, or I can show you. Actually, a very good way to learn is to go to the help. And there's all kinds of videos. See all these how-to videos? If you click that how-to video, it'll take you over to a website where I've created a whole bunch of videos. It's me, I did them. So you got my videos on how to set up the software in the way I like to use it. Gives you a kind of a quick little summary, and you got lots of little videos on all the different tools and the indicators and how to use the software and how to set it up. And so you can see how I do it. And as you come and you join our class, many of you, again, this is your first time. So you're just kind of getting your feet wet and you're just kind of learning how to do this stuff. It's going to take a little while. There's a little bit of a learning curve. You guys have two learning curves. You have the one learning curve where you have to learn how to trade. Okay, what is the Dow? What is the QQQ? What is a trend? What is a market moving through price and time? What is a retracement level? What are all these things that you have to learn? So you have to learn how to trade. How do I buy? How do I sell? How do I, get into the market? How do I get out? How much do I put in? How much do I take out? All these kind of questions are learning how to trade. And those are things that you're going to learn in class at the university. Plus, they're things that you're going to, learn here in the labs. And so this is why I created these labs. If you remember the conversation we had last night, I used to teach at the university just the classes alone. I didn't have a lab. And I asked the university, I said, hey, I teach at night. I teach night classes because I'm in the continuing education department, and I teach night classes, but I teach the financial markets and they're only open during the day. Can I come and teach classes during the day? Or I'll teach my night classes, but can I have a lab during the day that the students can come to when the markets are open? And they said, no, you can't do that because we've got other teachers who are using those rooms. And so I scratched my head and I said, well, how can I do it? And so we started going to the library, and we tried to go to the library, but scheduling rooms at the library was very difficult. Not very helpful down there at the library to help us have regular classes coming in and using that facility. They kind of had a lot of different things happening all the time, and there were chairs up sometimes and not up sometimes. We could get to the room sometimes we couldn't get to the room, so we'd schedule it, we'd go in, and there would be no chairs. So we had a lot of problems with that. We couldn't make that work down at the library. I had a student one time who was in the class, and he had a hangar out at the airport, and he had a big hangar and he hooked his computer up to it, had a big screen and everything. And he said, hey, why don't you bring the class out to the hangar and we'll trade out there. And so we did that for a little while. We brought the class out, but as after a while, he was no longer taking the classes anymore. He had finished all the classes. He didn't want me bringing all my students out there to his hangar all the time when he wasn't even in the class. So that didn't work out very well. So finally I decided, well, you know what? They got this Zoom thing. We'll do Zoom classes. And that was kind of a pain because then the students didn't have Zoom. And then it was like, well, it only goes for 30 minutes for people who have free, and then they miss half the class. And so they don't want to buy Zoom just so they can take come to the lab. And I just kind of broke down and I said, you know what? There is a company out there that does this. They have everything we need. Let's just do it on YouTube. Okay, so we decided we'd just do the labs on YouTube. So that's me starting a YouTube channel to do the labs for the university, and that's how we kind of got here. Now, we got a lot of students that come and join us who are not part of the university because it's YouTube, and YouTube's open to the world, and that's great. We love to have everybody. There's no restriction on anybody who wants to come to my YouTube channel. So if you want to come to the YouTube channel and join us and be a part of it, great. We'd love to have you part of the community, but realize it is a lab for my university classes. And so we do kind of start over at a new point every now and again, and we start a new semester. And so we go back and we start over. And so we'll go pretty fast, and sometimes it'll feel like you're being fed with a fire hose. But the whole idea is that you come and get exposed to the environment. All right. When we get into a new environment and we're trying to do and learn and do new things, the best thing you can do is just being exposed to it day in and day out every day. So I do these labs every day. I teach my classes Monday, Wednesday, and Friday at the university. Then we take a break, and then we teach another Monday, Wednesday, Friday. We take a break. We take another Wednesday, Friday. And I do that for the whole semester. But the classes, I teach them every day. I teach Monday, losing my voice again. Hold on. So I teach at the university, or I teach the classes online Monday, Wednesday, and Friday every morning for the stock market stuff. So those of you who are interested in the stock market, we can trade that every morning. This is where we are doing building ourselves an income portfolio and also a passive income portfolio. There's two portfolios that we want to build when we're trading the stock market. And then on Tuesdays and Thursdays, we do the power hour, which is the last hour of the day as opposed to the first hour of the day. Monday, Wednesday, Friday is the first hour of the day. Stock market, Tuesdays and Thursdays, the last hour of the day, which we call power hour. And that's where we do day trading. All right. So we do shorter term trading, and we do a lot of technical analysis when we do shorter term trading. Not that we don't do that here. We do. We do all of our mathematical modeling in the day trading, in the long-term trading as well, but it's not quite as intense as it is when we do day trading. Day trading is very much all about technical analysis and picking, try to get into trends. So we do that on Tuesdays and Thursdays, the last hour of the day. So those of you who are interested in technical analysis and day trading, come and join us then. Those who just want to do stocks, we could do those Monday, Wednesday, Friday. We do them every day. All right. So at least until I burn myself out and I can't do them any longer. So come and enjoy it while you can. And then when I burn myself out and I don't want to do this anymore, I won't, because I'm just doing it because, hey, I've got plenty of money. I'm independently wealthy. I don't need to do this. I just do it for fun because I love it. It's my passion. It's my hobby, and I love to share what I'm doing. And if I'm going to be doing it, I might as well share it. I got to do it anyway. All right. Because this is what I do with my real money. And so this really helps me out anyway. I come and do this every morning. I do it with you guys. And then once I shut it off with you guys, I go and pull up my real money accounts, and I do all basically the same things that I've just done here, only with real money. This is all demo account because we are learning. We are in a school classroom environment. So we don't trade real money. We trade demo money in the classroom environment. And that's because we're learning. All right. And we're just having fun. And then for me, this is just fun. It's my recreation and entertainment. All right. And hopefully you guys get to gain something out of it. I'm not telling you what to do. I always tell people, I'm not telling you what to do. I'm just telling you what I do. All right. And I've been doing this for 40 years, and I've pretty much got, all the money I need. Not that I don't want more. Who doesn't want more, right? You can never have enough until you're richer than Elon Musk. And even Elon Musk doesn't have enough. So we always working to try and make more money, have a little bit more comfortable life, buy a few more toys. But, comes a point where you got plenty and you just don't have to work anymore. And then you get bored, and then you just wander around the house in your underwear, looking out the window, wondering what to do. And so that's why I teach at the university. That's why I come and do these YouTube channels. And so it's my passion. It's what I love to do. And it's what I'm sharing with you. I have other passions, of course. I like to fly airplanes. I like to drive four-wheelers and motorcycles and go hiking and do all kinds of stuff. But, you know, after a while, you have to kind of just keep your life going and do exciting and fun things. I don't want to give up and just go lay on the couch all the time. That's not a fun thing to do. So I also have another company. I've sold two of my businesses. I still have two businesses left. One is real estate. So I have a real estate company, and I have both commercial real estate, and I have private real estate, houses and apartments, that kind of stuff. So, and then I also have Pitt News Magazine. Pitt News Magazine is my other passion. I love to do Pitt News Magazine. I went to, one of the things I did in school was, it was part of marketing and advertising. And I love the advertising side of it. I love the layout design. I love to do research. I love to do all this stuff. So I created a magazine, and just for fun, I'll show you my magazine. My magazine is Pitt News Magazine, and I work really hard on it, and I provide it to it's a service that I give to our students, right? And so it's not very expensive. It's really cheap, but we spend a lot of time. We record all the articles. It's really great service for you. And what we do is we put into the magazine each month. It's a monthly magazine. It's electronic. It's not printed, but it comes out each month, and it talks about the things we talked about in class for the month prior. So all the things that we talk about in this month in this class will show up in the magazine. So we write all this stuff down for you. I used to do what we called cheat sheets, and I would just send you cheat sheets of all the stuff that we'd work on. But I decided to turn those cheat sheets into a magazine. Of course, I've had the magazine since 2000. So it's been in publication for almost 25 years. We've been doing Pitt News Magazine. It's just been my passion, and I love it. I'm going to have Claire tell you a little bit about Pitt News Magazine. Some of you have heard this a little bit. If you don't mind, just listening to Claire tell you a little bit about Pitt News Magazine, and then we'll go on and we'll go in. I want to tell you about Heikin-Ashi bars, and we're going to look at the S&P and the other markets.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, and of course Mr. Lan Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Lan's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right. That is Pitt News Magazine. That was Claire. She's one of our authors and writes for the magazine. And we got a great version of the February issue. I'm so excited about getting the February issue out to you. I almost want to send it out early. It's so good because it goes into great detail about what we're doing with our passive income strategies. And that's what, we're kind of focused in at the university right now. The first two classes, we have the introduction to passive income, and then we have the advanced passive income. So we're going to teach them. Some of you have been here in this class, and we've been talking about that, and you see our portfolio where we have the ROC, and then we also talk about ROCC. So the first class at the university, the first three classes this first week, we're going to learn ROC, and then in the second class, we're going to learn ROCC. All right, so big difference between those two, and one is the beginner class, and one is the advanced class, and so we're going to kind of cover that here over the next 2 weeks. Because the university had me back those up right one after the other, the first one and the second one. So we go right in. We don't have any break between those two classes. All right. And we're going to give you the spreadsheet too. So if you subscribe to Pitt News Magazine, you get my UBI, what I call the UBI spreadsheet, Universal Basic Income, or the passive income spreadsheet, where we have all that stuff lined out for you and show you how to track that so you can see the difference. The problem is when you go into a trading software program like Track and Trade or any other program, your brokerage firm, they don't track ROCC. They don't do that. They don't have the capability, so you have to track it yourself. And we're working actually. The spreadsheet is kind of a pain in the butt. We'll admit it's a big spreadsheet. In fact, here I'll pull it up and show it to you. Here is the UBI spreadsheet, and you can see this is how you track your passive income portfolio. And it's kind of a big spreadsheet, and it's got all these different sections in here. And most of you are familiar with this because you've been with me for a while. But this is the UBI spreadsheet. And I have to admit that it's not done. And the version I'm giving to you guys is not up to date to the version I have that I've been using with my Real Money account. So I have to update the version that I give to the class, and that will come out with Pitt News Magazine. So when you subscribe to Pitt News Magazine, you get this spreadsheet as a bonus. All right. And of course, it has our trading portfolio in here. We come in, and this is where we actually trade the markets for money. Now you have to have money to make money. Sorry, it's a fact of life. So, or you have to have time. You can trade your time for money, and that's called a job. I don't know who wants one of those. Anyway, you have to have a way to make money to put it into your UBI portfolio. So you put it into what we call our cash cow portfolio, right? And so we can get on the gravy train, but you have to have money to go in there so it can make money, because we make our money make money for us. That's what a passive income is. So we have to have an active income too. Now, you can go drill teeth. You can be a dentist to get an active income. You can go be an engineer to be an active income. You can go work at the gas station like I did. And you can pump gas for a living and make money. All right. That's what I did before I got into trading. I got into trading around, I stopped working at the gas station when I was 20 years old. I didn't work at the gas station anymore. But I like to use that as a good example because there's many things you can do, right? I graduated from college and went into the professional world. But nonetheless, that's how you do it. You got to make money. And so I like to trade for money. All right. One of the ways I like to make money is to trade the financial markets. And I take that money, and then once I've made money trading and not investing, that's different. Trading and investing are two different things. We're going to learn that in our class too, the difference between trading and the thing investing. Investing is what we do when we're looking for a cash cow portfolio. We're going to invest in some of these markets, all right? And that's how we're going to hold on and make a passive income. But to actively trade to make an income to replace the income that we have by drilling teeth or fixing broken bones or pumping gas, I like to trade. And so I trade the financial markets for income. I take that income once I make money and I put it into my portfolio for my investments. And this is where we get the cash cow. And the cash cow is relatively kind of new. I mean, we just always did the traditional investing and, buy low, sell high, and hold on for a long period of time, buy and hold. And that's how we would do those long-term investments. And we did that for years. But the cash cow stuff, the ROCC, is new. That's only been in the stock market for about 2 years. And we got a little bit of history, and we're now doing that. And it's really cool and really fun. So I want to make sure you guys understand that there's different levels and different ways that you can trade the market and not get, myopically focused on saying, well, all I do is just buy the S&P 500 and put money in there and hold it for the rest of my life. And when I retire, I'll just start pulling it out till I run out of money. And when I run out of money, I'll just go out and, move to Canada and finish things off. I don't want you doing that. I don't want you running out of money. All right. That's one of the biggest fear that most people have, is that they're going to run out of money in retirement. All right. So we want to kind of avoid that. And I'm going to show you how to avoid that. First of all, if you learn how to trade, you could trade for money. And then you could use that income as a replacement, but you also want to have that passive income coming in. And so we're going to set that up for you as well. All right. So now we're going to come back into the charts, and we're going to talk about the trading side of it, the investing side of it, again, DIA. And the reason I want to introduce you to these four fundamental markets is because they are the most common, most popular ways of trading. Now, are we going to trade these? Yeah, we are. We can trade these. We can day trade them. We like to trade those in the afternoon, but we also want to invest in them. And there's some UBI possibilities with these markets. We're going to learn that in this first level here in the first week. So this week we're going to talk about some different markets. I'm not going to do that today because I want to kind of jump ahead. I don't want to get ahead of our class, but we're going to talk about some markets on how we're going to trade these with UBI possibilities. All right, universal basic income. All right, so we're going to get into that. And of course, UBI is a form of dividends. We're going to take dividends, but we have to figure out which markets are going to give us the highest dividends on some of these markets. We're going to show you how that works. It's going to be ROC when we trade these. And then next week, again, we're going to get into ROCC, which is a little bit different model. So we're going to get into the advanced model next week. This week, we're going to learn about the primary model. But the first thing we want to do is learn about these markets. So let's go in and I'm going to show you. In Track and Trade, we have this button up here called Heikin Ashi. I call it the cheat sheet, all right, or the cheats. These are the cheat codes. Now, to get it turned on, there's a number of ways to turn it on in Track and Trade. You can right-click your chart. You can come down here to chart settings, right? Chart preferences right there. So the right-click tool in Track and Trade does a lot of things. So you right-click lots of stuff. You're going to get all kinds of right-click menus everywhere you go. So right-click on everything, because the Track and Trade uses right-click menus everywhere. So right-click just on a chart, just right anywhere on a blank chart and come down here to chart preferences. And you're going to see Heikin Ashi right here. See it? It's right here. So this little setting right here, it looks kind of foreboding, but it's not really all that complicated. The reason we put all this stuff over here, I have this real phobia. I hate things popping up in front of my chart while I'm trading. And so all the preferences end up over here in the right-hand side. This is where all your preferences are. And I really like that. So you don't have, you don't have a preference for a tool and have it pop up over your chart. And then you can't see your chart while you're setting your preferences. And then you have to close it and then see what your preferences do. And you have to open it, make a change, close it, look and see what it did, open it, close it, open it, close it, open it, close it. And you're always opening and closing windows all the time. So I hate Windows because of that. It's always popping windows up in front of your face. And then you have to make a change in it. And then you have to close it to see what the change did. This way, you can just change it over here and then make the change on the screen. And you don't have to constantly be going in and out of your stupid window settings. And so that's a really nice feature. But right here, see this little Heikin Ashi? This is change your price bars. And if you turn Heikin Ashi on, it can be on any number of price bars. You'll notice in Track and Trade, we have open, high, low, close bars, which look like this. We have just high, low close bars, which gets rid of the open. And those are popular. We have the close only bars, which is just a line. We have an open bar, which is just an open. We have the candlesticks, which is the most common. And it didn't used to be the most common. It used to be open, high, low, close. This is what we all traded with, just like this, for years and years and years and years and years and years. We traded like this. And then everybody decided candlesticks were better. What's the difference, Lan? Well, there's no difference. It just makes the body between the close and the open fatter. Makes them cute. They're kind of like, Christmas lights. That's really the only difference. And, other than the fact that, well, that's really the only difference. It's just the color, the thickness of the body. That's all there is. So we went to candlesticks, and that's fine. That's all right. They're cute. All right, they're pretty, like little Christmas lights. Okay, so now we come in here, and now you can make any one of those types of price bars a Heikin Ashi bar. So the reason Heikin Ashi is not a bar type itself is because it's kind of like an indicator that lays over and smooths out the price bars. So what Heikin Ashi does is it changes the price bars. It's kind of like an indicator. All right, I call it the cheat codes because this is the open, high, low, close. And if you turn on the Heikin Ashi, it still has the open, high, low, close, but it changes the close. It changes the mathematics of it. See that? So I can turn on and turn off Heikin Ashi, and you can see the difference. Big difference. All right. See how that changes back and forth? So we come in here. Turn that on, turn it off. You see the difference. I like it on. Some people don't like Heikin Ashi. I do. But the reason it's in here is because then you can come into open, high, low, close bars, and you can make those Heikin Ashi bars too. All right. So now you got Heikin Ashi open, high, low, close bars. Well, Lan, I like high, low, close bars. Okay. Well, you can make those Heikin Ashi bars too. You can put the Heikin Ashi model on that as well. All right. So that's why it's kind of a unique. It's just an indicator that's stuck to the bars. So you come in here. I want to go back to candlesticks. Do we want them Heikin Ashi? Yes, we do. So we turn them on. Now, if you want it as a little button up here, so you can actually turn it on a little button up there, you have to right click on the handle, come down here, customize your toolbar, and it's in here. You got this little toolbar in here, and you can change things and you can put it in there. It's not there. Again, it's the software doesn't come out of the box with Heikin Ashi up there. and it's already put on, so you can see it's right there. And you just find it in the list of available tool buttons and you hit add and it'll put it in. Now I've got multiple tool buttons up here. So here's a tool button, here's a toolbar button, here's a toolbar, and you can customize these toolbars to have anything you want in there. And you'll notice that I have some of these things in here twice. Why? Because I have a line in here twice, I have arrows in here twice, I have some of these tools in here twice, Fibonacci rulers in here twice, rafts in here twice. And the reason I do that is because my screen is so big that if I'm working over here, I want to be able to go up to these bars and get what I need. Or if I'm working over here, I want to be able to get up to these bars without having to go clear across the screen. It's just my own personal preference. You don't have to do that if you don't want to. But I like to have that Heikin Ashi turned on so I can turn it on and turn it off right there from the bars. All right. So you don't have to go into this setting all the time to do it. Just turn it on right there. That's Heikin Ashi. And so those are cheat codes. And the reason I show you that is one of the important things about the software is because I like those. I think that really helps me be a better trader because I can see better where markets change over from red to green and where markets have a tendency to roll over the top of these things, right? When they go like that, and they're a little bit more accurate than the other version of the chart. So that helps me be a better trader. And I like to buy low, sell high. Sometimes we don't want to buy low, sell high. And like we talked in class last night, we can just start buying down in here, right? And we can just keep buying each time it drops. And that's called dollar cost averaging. And so we can just never get out. We just always be getting in. Okay, so each time the market pulls back, we start adding into the market again. Or you can do it on a regular basis. You can do it, daily, weekly, monthly. You can just keep automatically putting money in no matter what the price is. And that's called dollar cost averaging too. But if you dollar cost average into a market by trying to time it just a little bit, you can oftentimes do a little bit better. All right. Rather than, dollar cost averaging in right here and then having to have it draw back against you, you can try and dollar cost average in here. And if you get a little bit of a spot like that where it's a little crazy, you don't really care. You're like, well, it's okay. Pulling back, it's going green again. Okay, I'll add a little in there. And it goes down a little bit more against you. You don't care, right? Because it's not your full, you're putting a little bit of money in all the time over a period of time. And if you do it at these levels and dollar cost average in, that's a nice way of adding into a position. Now, this is the Dow, and the Dow is one of the most popular charts to do that with. All right, it's called dollar cost averaging, and just buy low, sell high. And then you may not sell until you get sell until you might do this for 10 years, 20 years till you retire. And then on the other side, where do you sell out, take profits out so you can live? Well, you put your money in down here. And then as the market moves through price and time, and you need to take some money out to live off of, you want to sell some here, 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 right? So that's where you'd be selling out, taking profit so you could live off of it if you wanted to do the dollar cost averaging. And of course, if you do it like that, hopefully you don't run out of money, but eventually you're selling off all of your holdings and you're going to run out of money. But you're at least buying low, on the way up, and then you're selling high when you take the money out. So that's your strategy for retirement. And that's really super popular, really common. In fact, it's the way that 90% of most people actually do this. All right. Actually, I take that back. I would say about 40% of people do this. All right. There's probably 60% of people just throw money in there randomly every week or every month or every day or whatever. They just throw some money into the markets, and whenever they have some, they just throw it in there. It's kind of like a bucket, and they just throw it in there at whatever price. I think that if you try to time it, you can't do worse. Maybe you can, but for the most part, you're probably not going to do worse by trying to time it just a little bit by looking at the color codes and the switches and trying to learn a little bit about how markets move through price and time. You're probably not going to do worse than just the random, just throw money in there every now and again, or how police officers and school teachers and firefighters and all those guys do it. They just take money out every payday, right? Every payday they take money out and throw it at the market. Whether the market's up or down, doesn't matter. They just take money out and throw it into a bucket. And in 20 years, you hope that they put money in there and the buckets still continue to get bigger. So there's different ways you can be more attentive to your money and watch it a little bit better and tend it a little bit better. And I think that if you try and tend it just a little bit better, learn a little bit more about the markets, you're going to do a better job of managing your money than just randomly throwing it in there like people do when you do a 401k or an IRA out of your paycheck. Okay, so kind of think about that. All right, so this is the Dow. So we got a number of markets that you can put money into, and these are different buckets that you can put money into, and they're already diversified. So this is diversifying across 30 different stocks, 30 of the biggest and best industrial stocks. So you can choose this one and you can put your money in here. You say, well, should I put money in all four of them, Land? Should I put some money in the SPY? Should I put some money in the Dow? Should I put some money in the Q? Should I put some money in the IWM? Where should I put my money? Well, they're already diversified. And so that would be a diversification of your diversified funds. And the reason these funds have been created the way they are is because they're already diversified. And somebody else is kind of watching them and manage them for you. And they will put, like, for example, in the S&P 500, this is the 500 biggest, best stocks on the U.S. exchanges, right? Now, the question was asked in class the other day that on the U.S. exchanges, there are international companies. So there's companies from international, like Toyota, for example, is on the U.S. stock exchange, but it's not incorporated in the U.S., so it can't be part of the S&P. They have rules. So it can be a part of the U.S. exchange, but the company has to be incorporated. And that was something I had to look up. One of the students asked, can a foreign company, even though it's on a U.S. exchange, be part of the S&P 500? And the rule is only if it is incorporated in the United States can it be part of the S&P 500. So Toyota, for example, is traded on the S&P 500, or not traded on the S&P. It's traded on the New York Stock Exchange, but it cannot be part of the S&P 500 because it's not incorporated in the United States. So the company has to be incorporated in the United States to be included in the S&P 500. That's one of their rules, okay? So when you diversify, you are diversifying across 500 different stocks. Now, you could say, well, I'm going to go buy individual stocks and build my own portfolio. Well, you can do that. And, it's a lot of fun. And I like to do that too. But if you want to diversify rather than just put all your money into one, all your eggs in one basket, this is a great way to do it. It's going to put it into the 500. And then there's people who are going to manage this for you. They're going to say, well, this company is no longer one of the top 500. We're going to take it out and we're going to put this new company in. Okay, so that is a management form of moving in and out. That's always the 500 best companies are always being moved in. And if one falls off, they throw that guy out, bring in the new one, and they do that all automatically for you, and you don't have to worry about it. So that's a nice way of diversifying, but it does diversify across 500 stocks. And so 500 stocks are going to be more stable. And you might like that. You say, oh, I'm a very stable guy. I don't like to have a lot of movement up and down in my stock. If I'm going to do this, I don't like to take big risks. Okay, well, this is going to be probably the safest one. Safest I put in scare quotes because anything in the stock market is not necessarily safe, right? There is a way, you can lose money in these markets. Markets can go down and then go down for a long period of time. All right, this is the last year, and the market's been going up quite significantly the last year. Do you think it's going to continue to rise? Well, if we look back at a longer time frame, if we come back and look, we can look at a weekly chart. This is what the market's done over the past, ever since 2022. Okay, so each one of these price bars represents 1 week. Well, we can also open up a 1 month bar. So we go to a monthly bar, and there's a 1 month bar. So that's what the market's done over a long period of time, clear back all the way back to 2014 back here. So from 2014, we can even go back farther. Let's just shrink it down. This is what the stock market has done all the way back since we got data all the way back to 1993 on this particular chart. So you can see, but there have been times. Now, each one of these price bars represents 1 month. And so if each one of these bars is 1 month, you can see for quite a while that market went down. Remember, between 2000 and 2003, that was 3 years that market went down. Then it went up, and then it flushed one more time, went down. And then it's been going up ever since, but it does have little, 6-month periods of time in here where it's been pretty bad. We had some pretty bad places in here. We had Corona right here. And then we had this little flufferty that happened here after, we can go through, and I've got a document that shows you what each one of these events were that caused this. And then we have this massive run right here. So that's been a big, beautiful run. Do you think that we've got something coming that's going to bring it back down for a little while? Well, you might want to take that into consideration. Or do you think it might go down just a little bit and then keep going? Or do you think that things have changed and it's just going to keep going up? You never know. Nobody knows what's going to happen. But oftentimes people will tell you, politicians will tell you all the time. They'll say, hey, the stock market is not the economy. That is the biggest bold-faced lie that anybody has ever told. I cannot believe somebody would be so stupid as to say that out loud. That is the biggest cockamamie, stupidest thing I ever heard anybody say. The stock market is not the economy. The stock market is the economy. What is the U.S. economy? It's the biggest companies in the world, right? The biggest companies in the United States. That is our economy. And what is the S&P 500? It's a representation of those 500 companies and how well they're doing. If the S&P 500, if the stock market is not the economy, what is? That is the stupidest thing that a politician could ever say. The reason the politicians say that the stock market is not the economy is because they want to pass bills that causes the stock market to go down, and they don't want you to get mad at them for it. All right. So they tell you the big, bold-faced lie that the stock market is not the economy. This is the U.S. economy right here. And if you believe in the U.S. economy and you believe that the U.S. economy is going to grow and be better over time, you can invest in the U.S. economy by buying the SPY. That's what it is. That's what the S&P is. So just because markets have a tendency to go down like this, and it goes down like this, and it goes down like this, and down like this, and down like this, and you're like, well, it's really high, it can go down. That's not necessarily true. The U.S. economy does not have to flush down. It doesn't have to die just because a chart says that it's really high. The U.S. economy is doing well right now. And we all know the reason it's doing so well right now is because the last administration spent themselves silly like drunk sailors. All right. And so that put a lot of money into the economy, into the markets, into the stocks, into how well these companies could do. They had lots of money being spent. So all this money going out went into these big companies, and they did really well. Now, the problem is you can think about this from an economic standpoint. If the next administration comes in and says, you know what, we got to do something about all this debt that we got. We got so much debt, and I'm not going to lay it all on the last administration. Every administration since the beginning of, clear back to the beginning of time have spent money like drunk sailors, every single one of them. And Trump had a time in here where he was in during Corona, and he spent a whole bunch of money to get us out of that hole right there and get the economy coming back too. So you can't just say it's one guy. They all do it. Congress, it's not their money. So they spend it like drunk sailors. And why do they spend it? Because they put it back into the economy to try and drive things up. And in a politician's mind, you can't waste money. You can't waste money in a politician's mind, because every dollar that gets spent goes back into the economy, right? And gets circulated back into they think they're creating jobs no matter what they do. If they want to go out and have a commission that tests the thickness of how thick you can, what's that really crazy one? It's, they have a commission that tests how thick ketchup is. So if you have an advertisement on your ketchup bottle that says thick ketchup, well, that's regulated by the government. And there is a regulation for how thick your ketchup is, because they don't think you can buy a bottle of ketchup and say, this isn't thick enough for me. I like thicker ketchup. So if you want to put the word thick on your ketchup bottle, it has to go to the government, and the government has a little testing system, and they have a whole department that tests how thick ketchup is so that you can have on your list. They don't think that's wasting money. Why? Because they're funding a bunch of jobs. They're creating jobs in the government to test the thickness, and it's providing you with a service so you know how thick your ketchup is. That's a real thing. They really do that. They have a whole department test the thickness of ketchup. All right. And so if you are a ketchup manufacturer, you're regulated on how thick your ketchup can be. And so that they don't think that that's wasting money, because it's providing a service to you and it's creating jobs. And that money goes back out into the economy. Those guys test the ketchup. They get a paycheck from you, the taxpayer. They take that money. They go out and they buy things from Amazon, which is you, because you have a business and you sell things on Amazon. And now you are getting money because the government created a job to test ketchup, and that circulates money through the economy. That's the thought process of a politician. And that's why they don't mind spending money the way they do. Okay. Because you can't waste money, because everything goes out into the economy and causes a circulation of money. So the question is, can this market flush? Yes, it can. And maybe this administration is going to look at the debt that we're in, and we're going to have to bring that debt down. Now, we know that Trump and Elon Musk and Doge and all these guys have a big plan to try and bring the debt down. They want to try and bring the debt down without bringing down the economy. Are they going to be able to do it? That's the question. They want to bring the debt down. If they don't bring the debt down, they'll just keep spending like drunk sailors. This will keep going up for a certain time, and then eventually we'll just go bankrupt and it'll come all the way down here, right? So they want to be able to keep this going up without bankrupting the country. And so that's the question. Is this going to be able to stay on this massive uptrend like it is, or are we going to get a big flush back down? And if we're going to get this big flush back down, what's going to cause it? What's going to cause the market to flush like that? All right. And also all that spending on war. War is good for the economy. Why? Because they send the money over to Ukraine, billions and billions of dollars. And what does Ukraine do with it? Well, they buy bombs and missiles and tanks and trucks and bullets so they can kill people from the U.S. Manufacturers of those things, right? So we manufacture. A big part of our economy is war. So if we don't have war, you can expect the market to maybe flush too, because we need war. We are in a war economy. Well, a very large part of our national income comes from war, selling bombs. The problem is we're selling them to ourselves. That's the problem. We're not actually selling the bombs Ukraine's not actually buying the bombs from us with their money. We give them the money, then they turn around and give it back to us. And you remember hearing the politicians say, don't worry about it. We're the ones making all that money anyway. They're taking the bombs and they're bringing it back. They're just buying our bombs. We're just buying our own bombs. So that's what ends up happening is we're buying our own bombs. And then we give it to them to go blow them all up because they want to have bombs. And if they don't have a war, then nobody's using their bombs, and then they can't make more bombs. And we got to make more bombs so we can make more money, right? So we have to go kill people. All right, that's the nature of the beast. So we love our military. We're all military-loving people, but boy, we sure hate to kill people, don't we? But we have to drop bombs. We have to kill people so we can make money. Said the ugly part out loud. That's the nature of the beast. So what's going to happen with that S&P 500? Is there any reason to think that it's going to flush? Well, if you think it's going to flush, you probably don't want to be putting your money in this market. All right. That's the nature of the beast. So I still believe a little bit that the market's going to still got some upside potential. I think that the U.S. economy, this market doesn't have to come down. It doesn't have to flush. It doesn't have to have a pullback like this, because this is just a representation of the U.S. economy. And the U.S. economy doesn't have to flush unless there's some sort of a fundamental reason that causes it to do that. It can just keep on going, because as long as it's managed properly, the problem is we have to pay off that debt. And if we pay off that debt, well, if we do it properly, that could cause the market to go up. If we do it wrong, it could cause the market to go down. So it depends on your politicians and whether you believe that the leaders are going to be able to pay off that debt without causing the market to flush. Now, there's a number of different models of things that they think they can do. Now, Trump, I know he thinks that he can do it with tariffs. He thinks tariffs, we can keep our U.S. economy going by bringing all these jobs back to America, right? By telling people that they have to build in America or else they're going to get a big tariff. So they're going to bring all this industry back to America, which is going to cause this thing to go up. And then he's going to tariff the outside companies that sell stuff to us. They're going to collect taxes from them. And that's how he's going to pay off that debt without causing the market to flush. That's his idea, and that's the concept. And so that's what he's trying to accomplish. He's trying to pay off that debt without flushing the market, without flushing it, taking all that money out of the U.S. economy to do it. So will it work? Well, it's worked in the past, and that's how we used to do it. And it worked very well in the past. So he thinks that if it worked that well in the past, why not try and make that work again now? So basically tax companies, foreign companies, instead of taxing the U.S. citizen. My idea, my thought here is that we're so far in debt, trillions and trillions of dollars, to the point where our national debt, the interest on our national debt is greater than our military industrial complex budget. I mean, we're paying so much money. He's going to have to do both. He's not going to be able to get rid of the entire tax code and replace it with tariffs, which is what we used to do. The United States, it was in the U.S. Constitution that it was illegal to actually have a tax, and it wasn't until they changed that, had a amendment to the Constitution that said that, hey, you know what? Let's tax the people. So they started taxing the people instead of taxing, products coming in from foreign countries, and that's how we ended up with a tax, with an income tax. So we didn't used to have an income tax in America. So now we do. So they tax us instead of the foreign goods. So the taxes that they used to tax, the tariffs from other countries, now they tax us instead. So Trump wants to go back to the other model previous and say, let's tax the other countries and stop taxing American people and bring back the economy that way and pay off our debts that way. But I think he's going to have to do both. I mean, we're so far in debt that he's going to have to put on all the tariffs and make all that money, and he's going to have to tax the people too. He's going to have to do both. It's the only way you're going to get out of this hole. Otherwise, we're just going to kick the can down the street and let our kids have to deal with it. The problem is we are the kids that are having to deal with it. They kick the can down the road to us. And if we kick the cans down the road again, we'll probably bankrupt the entire country. So we can't really be kicking the can down the road any farther than what we have. We're at the point right now, Elon Musk said, we're at the point right now that it's compounding that debt to the point that there's no way we'll ever be able to pay it off. And so they've got some models. One, Trump's model is to do tariffs. And I think he's going to have to do tariffs and tax the people. He's going to have to do both. It's the only way it's going to ever pay this thing off and get it down, or we're going to just bankrupt the whole country. And if that happens, then it doesn't matter if you got money in the markets or not, because it's just going to all disappear. There's another model. There's another model that is being offered by some people, and it's the model, and you're seeing them do this too. And it just changed recently. They just barely passed a law that they can use Bitcoin, believe it or not, Bitcoin to pay off the national debt. And they've opened up Bitcoin. The Senate passed a bill. The House passed a bill that allowed Bitcoin to be used by banks. So banks could use Bitcoin. And Biden vetoed it. So that didn't ever pass. The banks want to get involved in Bitcoin. Bitcoin is a very stable coin. It's a store of value. And so we use it kind of like gold. So if you buy Bitcoin, it's kind of like holding gold. Does it go up and down? Yeah, it goes up and down, but so does gold. So it's rare, like gold. There's only a certain amount of them. In fact, gold, you can go out and mine it and get more. Bitcoin, you can't. There's only a certain number of Bitcoin. And so Bitcoin is a store of value. You think of it as a currency, but it's not really a currency anymore than gold is a currency. You can trade gold, you can buy and sell gold, but you can't go down to a store and really trade gold. Now, there's some stores that let you buy with Bitcoin, but really that's not what Bitcoin, kind of its major idea is. It's more of a storage of value. And if they open this up, so the House and the Senate have already gone through and passed this again, they're going to try and get this bill to President Trump's desk, and he will sign it, and that will allow the banks to start using Bitcoin as a foundational structure for their businesses. And it's very stable. It's a good thing to do. This is a good idea. And there's a way that they could have, because the US holds a whole bunch of Bitcoin. And so if they do that and start using Bitcoin in the economy and allowing banks to actually start using Bitcoin, it could push the price of Bitcoin up. It's right now $100,000. They're estimating that if this happens, Bitcoin could go to $700,000. So I have a lot of Bitcoin. Well, not a lot. I don't have a lot of Bitcoin. I have one Bitcoin, a little bit more than one. I've been buying a little bit every month, dollar cost averaging in. When the market pulls back a little bit, I'll buy some. But I've got myself a nice little storage of Bitcoin just in case it goes to $700,000. It's 100,000 now. If it goes to 700,000, that's 7 times my money. Now, again, I've mentioned this before, that Goldman Sachs says that they anticipate Bitcoin will go to $1 million by 2030. So 2030, that's pretty good. That goes from 100,000 to $1 million by 2030. That's what they're estimating. But this other estimate that I saw on some analysts say the other day, that they were saying, well, if this bill goes through, it could push Bitcoin up to 700,000 relatively soon. Not all at once, but it'll go pretty quick, up to 700,000 as the banks start to incorporate it into their business. Maybe that projection is by 2032, because that's just 5 years. In 5 years, you go from 100,000 to 700,000, or like Goldman Sachs says, they think it's going to go to 1 million. So that would be a nice thing to do with your money too. So you make money trading in the stock market, take it and buy some Bitcoin. I don't know. Yeah, maybe it's a good idea. They recommend a 2 to 5% of your portfolio being in Bitcoin. I know some people have way more than that, and I'm one of them. I have way more than 5% of Bitcoin in my portfolio. But I do it in derivatives. I have some derivatives. We've done some options on Bitcoin. So those of you who are interested in options, we have options that we can do too. Let's go look at the QQQ from a longer standpoint. All right, this is the QQQ. All right, the QQQ is 100 stocks. And so the S&P, this is 500 stocks. The 100 stocks that are in the Qs, this is from the NASDAQ. And it's very heavily weighted towards the tech stocks. So Microsoft and Apple and Google and Amazon, they're all in the NASDAQ, or in the QQQ. All right, it's these big tech stocks. And so you can see it's a little bit wilder ride. This is a daily chart. Let's go pull up the monthly chart. So this is the monthly chart of the QQQ. And you can see that it kind of had a slower start than the S&P, but man, it took off just like crazy too. But you'll notice that it's kind of a little bit more jumpy. All right, it's a little jumpier, but it makes more money than the S&P, but it also loses more money than the S&P when it goes down. So it's a little bit more volatile. But people like this because it is in the big tech stocks, and everybody likes to own Apple and Amazon and Netflix and Google. And this is heavily weighted towards that. And it is only 100 stocks as opposed to 500. So that's not going to be quite as smooth, right? The ride's not going to be quite as smooth. It's going to be a little more bumpy, but it's had a tendency to make a little bit more money overall. And then we have the Dow, which is 30 stocks, and we're going to go put that onto monthly. Let's just go and see what that's done over a long period of time. And you can see this one goes back as far as 2014, and that's your monthly chart on the Dow. And it's done basically the same thing. We'll turn on Heiken Ashi so we can kind of see. But over a monthly chart, remember each bar represents 1 month. You've had some pullbacks that have been pretty nasty. That'll last. This is almost a whole year that one pulled back, and then this was kind of a quiet year. But overall, the market's done really well. This has been a really quiet year right in here. But, starting right in here about 2020, it looks like November of 2023, that market started to go straight up, right? Again, they started spending money like drunk sailors, and that's what caused that. Lots of money going into the U.S. economy. It causes the economy to go up. So if the government prints a lot of money, you anticipate the market. It's called quantitative easing, all right? So quantitative easing. They lower the interest rates, they print more money, and that makes the market go up. So eventually they have to tighten that up. And when they tighten it up, this is what happens. All right. So right now they're printing lots of money, and they have quantitative easing has been going down. So we got a big rally right here. Plus we got, a lot of confidence in the market. I think a lot of analysts believe in the Trump policies. And since they did so well last time, they think they're going to do well this time. There's no reason to think that the market's going to flush. But nobody knows, right? Nobody knows what could happen. There could be some, world event that caused it to flush too. Like a World War III could really cause the market to flush. So we want to try to kind of avoid those things for more reasons than one, right? So we're going to come in here. Let's go down to this one here. This is the Russell 2000. There's actually 3,000 stocks in the Russell. The Russell 2000 are the bottom 2,000. There's the Russell 1000 and then the Russell 2000. Now, actually, the Russell 2000 is a little bit more popular than the Russell 1000, believe it or not. Okay, so we generally trade the Russell 2000, which are the small cap stocks. And again, they're not weighted equally. It's kind of weighted a little bit higher. And we talked about that last night in class, which ones are a little bit higher. So if you come in and look at the Russell, and now this is small cap stock, so you can see it's even a little bit more difficult to go into, right? The small cap stocks, but when they do grow, they grow pretty well, but they're pretty stable. But you can see big run here, a little pullback here. But this is a monthly chart. And so if we shrink that down all the way back. This is the small cap stocks. These are little companies. Now remember, these are generally traded on the American Stock Exchange. And the American Stock Exchange is where Apple got its start, right? Apple started on the American Stock Exchange, and then it went to the New York Stock Exchange, or to the Nasdaq actually. So it moves. These graduate, right? They graduate out of the small caps and they move up into the bigger caps. As they become larger, they can move up into the larger exchanges. And so this is the Russell. All right, so that's 2,000 stocks. Now we can come in. I'm going to show you. I can't do it in Track and Trade because it doesn't do this, because it's a trading platform. But we can come over to some of these analysis platforms on the internet, and I've got one I like. It's called FinViz, and you can come in here and you can do a comparison. And so we can come in and compare. Let's compare SPY against QQQ. So there's what the S&P and the QQQ look combined together. All right. So you can see the Q is the orange one, and you can see that when it's down, see down here, when it's down, it's lower than the blue one, but when it's up, it's higher than the blue one. So that's the Qs, all right? QQQ. When it's down, loses more, but when it's up, it makes more. And then again, it comes down. When it's down, it loses more than the S&P, but when it goes up, it starts to make more. But it didn't make more all the way from August of, what's that? Does it have a year in there? I don't even see the year listed. I guess we're just going back 1 year. Okay. But then the S&P actually outperformed all the way until the very top. And then the Qs caught up to it and outperformed it. And then it stayed higher. So the Qs stayed higher up in here. But you can see the S&P actually outperformed the Qs through this August, September, October, November, December timeframe. And it wasn't until into the December that the Qs actually outperformed and stayed above the S&P. But back here, it fell down. The Qs were lower, and then the S&P was higher. And that's why Warren Buffett says most people would be better off just putting their money in the S&P, and that's it. Just put it in the S&P and walk away. So, goes back to that thing. What we want to do is we want to be able to come in and look at the S&P, and we want to try and put our money in, buy low, just keep putting your money in at these lower spots, right? Try and put your money in here, and I think that's your dollar cost average is going to be a little bit better trying to do that. And that's kind of the name of the game. Now, we're going to go in and we're going to start talking about dividends. So we're not going to do that today, but we're going to start talking about dividends and some different funds that trade these S&P, the Qs, and they actually show you how to pay dividends, which is what I call the UBI, Universal Basic Income. And that's how you get independent passive income, all right, off of your active trading. So we want to do that, and we'll show you how to do that. We'll do that on Wednesday, all right? Today is, oh wait, that's today. What's today? Today is Wednesday. So Friday we'll talk about that, okay? That's what we're going to do on Friday, because tonight we're going to start getting introduced to that in class. So those of you who are in class tonight, that's what we're going to talk about. All right, so that's just been a real quick overview of kind of the fundamentals of the markets, how we read them from different points of view with different stocks that you can trade. And I wanted to do one more little comparison here. We can also put in here the DIA. And so there's the Dow, and you can see it's the Dow 30, and it's the green one down here. A little bit more stable because it's the Dow. And the reason why you would trade that one and not one of these others is that it's a little bit more stable. Okay, it's not going to jump up and down as much. So there's advantages to that. And again, we're going to talk about some of the advantages when we start talking about different markets that we're going to use for UBI, Universal Basic Income. All right. And we got one more in here. I keep forgetting the symbol for that. It's the IWM. So we can get in there and we can see the Russell 2000, and that's the red one. So the red one. So you can see all three of those comparative in there. And out of all three of those comparative, I think that the S&P has been doing the best, although you could get into the Qs, and the Qs have been doing really well too. And lately the Qs have actually been outperforming the S&P. But those are your views right there. Those are the four big indexes of the financial markets. And if you want to just buy and hold or buy in a dollar cost average in over a long period of time, that's why we talk about the S&P being the one that you probably want to do that in. All right. So that is the name of the game. S&P 500, dollar cost average in, and away you go. Rich, rich, rich beyond your wildest dreams. but you do need time. So what if I don't have a lot of time, Lan? Well, there's other ways and other things you can do with leverage that we can do so that we don't have to worry about just holding on to this for 30 years, because we ain't got 30 years to go till we need the money. So we got to do other things, and there's other ways to do it. So that's what we're going to learn coming up in future classes. All right, I do have a Sunday school lesson for you. Let's end with our Sunday school lesson. Nobody knows where the market's headed next. All right. As traders, we always want to make our very best guess at trying to determine market direction. I call this a swag. It's a scientific wild ass guess. All right. Since nobody knows where the market's going to go, nobody knows what the economy is going to do. We can always make our very best guesses. We want to be as good at our guesses as we possibly can. And that I call a scientific wild ass guess. All right. Don't make wags. Wags are just wild ass guesses. Don't just wild ass guess yourself into the market. Try and be as scientific about your wild ass guesses as you possibly can. So do study and technical analysis, do the math, do your fundamental analysis, kind of read the charts and kind of try and figure out a little bit of what these markets are doing when they rally and fall. And that's what I'm trying to show you here today. Just the simplest form of it, of a nice little green trend versus a red trend. Try and dollar cost average into these markets when they're down so that you can take advantage of when they're rallying. And then when you're ready to start taking money out, take money at the top, right? Take your money out when it's high and put it back in when it's low. Or if you're in the just take out mode, take it out when it's high. And if you're just on the put it in mode, put it in when it's low. Buy low, sell high. All right. That's the name of the game. And you don't have to buy low, sell high on every single one. You can just buy low for the next 20 years. Then when you take it out, sell high, sell high, sell high, sell high, sell high when you take it out. You can do it like that. You're always just buying, putting in low. And then when you're ready to retire, take it out on the high greens. All right. So that's how we do it. And if you have any questions, let me know. We'll see you in class tonight at the university. Be there or be square. All right. And class starts right at 6 o'clock at the Udvar Hazy building, 204. If you can make it, make it. We'll see you there.